welcome everybody to the Understanding Risk BC online symposium and event series. My name is Jessica Shoebridge, and the session this afternoon is Finance in Focus, Incentivizing Investment in Risk Reduction and Adaptation, with an esteemed group of panelists joining us today. I'll let Puninda introduce them all individually a little bit later. First of all, thank you to our sponsors this year, without which this wouldn't be possible. We rely on these organizations to bring this programming to you and to bring it to you at a low cost level to make it accessible, hoping to encourage a diversity of voices. So Natural Resources Canada, the Canadian Safety and Security Program, as well as the Insurance Bureau of Canada, our Provincial Office of Housing and Construction Standards, the Earthquake Engineering Research Institute of British Columbia, BC Real Estate Association, and I guess we're not allowed to say EGBC anymore, Engineers and Geoscientists of British Columbia. So huge thank you again to those sponsors. A little bit about Understanding Risk BC. As mentioned, it's a global initiative through the GFDRR, Global Facility for Disaster Risk Reduction via the World Bank. And so they have these global forums, and we've been hosting these local spin-off events. This is the third time. It's our first time, obviously, doing it online, so definitely different and kind of learning as we go. But I'm really proud of the team and everybody who's participating, you guys on our panel today, everybody who's chipped in to make this happen despite the challenging circumstances of making it all come together. So really happy to be here and to be putting on this programming. Part of what we're doing with these symposiums is experimenting with implementing Sendai on the ground at the local, regional, provincial scales. So Sendai is a global framework to which Canada and British Columbia are signatories for disaster risk reduction. And really looking at what does it mean to implement that on the ground? Who are the players that need to be connected, and what actions need to be taken? To me, this circular diagram on the right can be simplified through the spectrum of looking at science policy action. Science is, broadly speaking, I think we can weave in science, traditional knowledge, modeling, those kind of components there. And how do we connect that to the policy choices that we make as planners, as engineers, as decision makers? And what are the kind of actionable pieces that are associated with those policies? A big, huge one being what we're talking about today, the finance and funding. So how do we get the money? Where do we find the funding sources, the capital to implement all the actionable strategies, the disaster risk reduction strategies that we develop and seek to implement? I think I will pass it over to Puninda, who is our gracious moderator for the session. Puninda is a sustainability consultant with the Delphi group. She works on sustainability strategies and climate risk disclosures. She has previous experience in the commercial real estate investment sector, working on climate resilience for real estate investors across the portfolios. And she's been recognized as one of Canada's top 30 under 30 sustainability leaders by Corporate Knights. So without further ado, I'll pass it over to you, Puninda.
Great, thanks, Jessica, and thanks for having me, and thanks everyone who's joining us today. We're very much looking forward to sharing this virtual space with all of you over the next hour and a half. I am joining from the traditional territory of the Anishinaabe, Huron-Wendat, Haudenosaunee, and Chippewa people from Brampton, Ontario. As Jessica mentioned, we've got an exciting session ahead. In terms of the layout of today's session, we will start with brief presentations from a panel of subject matter experts, followed by an interactive dialogue, and ending with an audience Q&A portion where the panel will get to address your questions. As Jessica mentioned, you can ask your questions via the Q&A feature throughout the session, and we will address those at the end. And we would also encourage all participants to use the chat for discussion to chime in throughout the session as well. So in terms of setting the context for today's session, as mentioned, it's focused on funding and financial incentives for risk reduction and adaptation. And given my background in commercial real estate investment and in climate resilience, that's kind of the framework I'm using to set the context here today. We know that climate change poses, clear and material risks to the building sector. The reality and prospect of more intense extreme weather events presents major financial and social risks, not only to infrastructure being at risk, but also livelihoods. And due to increased severity and frequency of climate disasters, real estate investors are showing urgent concern for the risks that climate change is posing to their assets, turning their attention to adaptation planning for their real estate portfolios as a priority. And effectively managing climate risk requires data-driven insights, robust stakeholder engagement throughout the ecosystem of a real estate portfolio, which includes insurers, investors, property managers, asset managers, building occupants, and the communities in which they operate. And it's about reducing risk, within building operations, developing more resilient buildings, and as well as unlocking the value of data analytics to inform property-specific adaptation planning. And we're seeing investors increasingly ask these questions about climate risk of their property portfolios and, what are asset managers doing to address these risks in order to secure long-term value. And investors are also increasingly looking for information about climate risk at the market level, with some beginning to make decisions about where they choose to invest their assets. And in light of this, a city's resilience or adaptation policies, financing strategies, and infrastructure investments are becoming more and more important to real estate investor decision-making as well. And as investors, demand more granular climate risk disclosure, we are seeing increased adoption of reporting frameworks like the Task Force for Climate-Related Financial Disclosures, or TCFD, which provides organizations with a process to figure out, what climate-related risks or opportunities are being assessed or managed at the organization level. And despite all of this, we know that there are gaps that continue to persist, mainly financing gaps and how funding is made available and to whom, and how is it accessed, as well as climate risk data gaps that continue to persist. Also, it's important to examine and understand whether such investments in risk reduction and adaptation are being made with an equity lens in mind. And so our panelists will share some leading thinking and practices on the why and how of incentivizing and investing for risk reduction and adaptation. And we will dive into many of these topics during our discussion today. But before we get to it, we'd first love to hear from all of you. And you can use the chat functionality here to chime in, and I'll read out your responses. Jessica's put in the chat here. The question we're asking you here is, what is the single biggest barrier to funding or financing your resilience project? So if you want to chime in with your responses there, we'd love to hear from you. So someone has responded here, Murray, stating homeowner incentives to invest in retrofit measures being a barrier. Understanding who to ask. So access related issues, developing the business case for resilience, knowing what is available or restrictive or prescriptive programs, no PACE financing available in BC. Cost of assessing risk, identifying and prioritizing mitigation and adaptation measures. Again, who to ask, so access related issues. Jennifer's noted here, seeming lack of models capable of internalizing costs of inaction and adequately valuing regenerative capacity and social determination of health. Angie's noting here, we've not yet added or integrated climate risk into our standard formal risk assessment processes. So the siloing of these processes, for example, infrastructure project design related risk analysis from a scope, budget, and schedule perspective. The downstream costs associated with making homeowner improvements, the limitations of senior government infrastructure funding programs. And lastly, no source of funding. So again, access related issues. So from business case to lack of integration to access to funding, all of this clearly resonates with everyone here. So that's great. Thanks everyone for your responses there. So now we'll get to hear from our panelists. As mentioned, we'll have a lightning round of context setting presentations from our 4 panelists, and each panelist will present for a very short 3 minutes, but we'll have time for some interactive dialogue after that and hear more from them. So kicking us off is going to be Matt Osler. Matt is a senior project engineer at the City of Surrey. He has been leading Surrey's coastal flood and sea level rise related climate adaptation work for the past 6 years. With that, Matt, I'll pass it on to you to get us started.
Thanks very much. So I'm going to just explain a little bit about our journey here at the City of Surrey to fund some large-scale risk reduction initiatives related to sea level rise and coastal flood risk. And just trying to start to see the discussion here today, and looking forward to hearing from all of our attendees today. So in terms of the financial side of our journey, this work dated back about 10 years ago, and we had sort of the city's core funding through a drainage parcel tax that allowed some initial technical risk assessments to commence. And as the project unfolded, we were able to leverage some additional grant funding. And we had some influences from provincial guidelines to get us started, and also a lot of work from community organizations and institutions. And then for the last roughly 4 years, starting in 2016, we put a lot of effort into co-developing solutions with our stakeholders, and this really helped us secure stakeholder and political support to move forwards. And it helped forge a lot of relationships that would become very fulfilling in terms of actually implementing projects on the ground. And if you're interested in that process, on our website, surrey.ca/coastal, you can download a lot of the documentation that came through that process. And then lastly, and this is the phase we're currently in, is implementing large-scale capital projects. And the challenge here is, can we accelerate and build our capacity to implement these initiatives faster than the risks are increasing from climate change? We looked at how costly this would be over the next 80 years under 1 meter of sea level rise. And an interesting finding is the first decade is actually the hardest. We've got a lot of sort of deferred costs, and it's expensive to get things started. And then surprisingly, some of the costs we expect will taper off as a lot of the core risk reduction initiatives are implemented. So just wanted to reflect on where the funding came to implement some of our projects. So my apologies, I've got municipal funding in the center of the pyramid here, but that's just the world that I think in. And what we started to do is stack our funding sources, and it was really important to understand what funding was available. And what's interesting is once you start leveraging and bringing together multiple partners, that's where we found the real opportunities to make a difference in, that's my timer, in reducing risk. So just to wrap up, with the funding available, we put together a suite of projects and then built a business case to identify if this is cost effective. And for our project, we were quite surprised that when you add up all these different sectors that will have a reduced risk exposure, we found an over 100-to-1 ratio of benefit to cost for these initial actions. And with that, I'll pass it on to the next speaker.
Thanks, Matt. Next, we have Ujala Qadir. Ujala has 16 years of experience working on international development, focusing on climate and disaster risk reduction. She currently supports the Climate Bonds Initiative in the development of science-based green bond standards that are aimed at shifting economies towards climate compatible and resilient investment. Over to you, Ujala.
Thank you, Puninda. Good afternoon. I won't introduce myself as Puninda has done so already. Just to introduce quickly Climate Bonds Initiative though. We are an investor-focused nonprofit. We're based out of London. And what we are focused on is mobilizing the $100 trillion bond market towards climate resilience and towards low carbon development. So I'd like to start off with some good news, which I'm sure many of you are aware of. Which is the fact that the global financial capital has more than tripled over the last 3 decades. So we actually have roughly 10 times of global GDP of capital available right now in the world. So in a sense, we're awash in capital. There is a lot of finance out there, and the rates of borrowing are near zero and very low. And so I think there's a huge opportunity here for us to figure out how do we shift this low cost capital towards the right kinds of investments. And that's where I think green bonds lend themselves really well to this shifting of capital. So green bonds, for those who aren't familiar, are just regular bonds with an added, I would say the use of proceeds of those green bonds are dedicated to projects that can be labeled as green, that can be defined as green. And then there are additional reporting requirements around green bonds. Other than that though, green bonds are regular bonds. And that's the beauty of them, is that, your mainstream investor can pick up green bonds. And the momentum in this market has been tremendous. And we've seen great growth, particularly over the last couple of years. And so far, cumulatively, we're almost hitting our $1 trillion target of cumulative issuance. In Canada, there's also momentum that we're seeing. We've seen $25 billion in cumulative issuance to date. We've started doing some preliminary resilience screening at Climate Bonds Initiative, and I can't really present all the results yet, but part of this screening has shown that only one bond in Canada has had a real focus on adaptation and resilience, and that was from the province of Ontario on flood protection. So this trend is really part of the larger trend in the adaptation and resilience representation in the green bond market. So A&R, adaptation and resilience, has been very underrepresented. Less than 2% of proceeds in the green bond market can be identified explicitly as financing adaptation investments and infrastructure. And we see several barriers to this, or why this isn't happening, related to knowledge and capacity, return on investment, and mismatched sort of time horizons. So I think there's a huge opportunity here. The green bond market is growing, and the mitigation side we've kind of dealt with as we've advanced it significantly. But from the adaptation resilience side, there's a lot of work to be done and an opportunity to be taken. And I will end there.
Great, thanks so much, Ujala. Next up, we have Dan Oprescu. Dan is the Director of Risk Surveillance at the BC Financial Services Authority. And BCFCA oversees more than 6,000 businesses in BC and works closely with stakeholders with a mandate to focus on the stability of the BC financial system. Over to you, Dan.
So I'll start with introducing the organization. The BC Financial Services Authority is the regulator for BC credit unions, insurers, pension funds, BC trusts, and BC licensed mortgage brokers. We apply a risk-based integrated framework. The core of our mandate is to protect consumers. We look at all risks, of course, and therefore naturally based risks like single events, earthquakes and the like, or longer term impacts, floods and so on, are in scope for the financial services regulator. This may seem a little bit surprising, but because it's not strictly about money, but the exposure of the built environment and people, which keep increasing over time, does impinge on the financial condition of individuals and businesses. To focus a little bit more on why natural events matter, of course, the primary impact would be casualties and related liabilities, but everything that supports the material side of life, homes, contents, businesses, all the infrastructure, utilities, public buildings, everything has a financial value and interacts with the financial flows. And of course, the broader scope is the overall economy, which is underpinned by all the material elements that can be impacted by natural disasters. And we are in a unique position to examine the distribution of losses coming from a natural event or from climate risk across a very wide spectrum of what we call loss bearers, because consumers and businesses, if we start at the bottom, whether insured or uninsured, stand to bear some of those losses through the interaction with their debt payments or insurance payouts. But then financial institutions and the capital markets that link all the financial flows together stand to transmit those losses in places that we wouldn't expect. We've heard from Ujala the importance of capital markets and how through green bonds and other climate-related financial instruments, the natural world is linked more and more directly to the world of finance. And of course, backstops, culminating, of course, with the government, is an important element of the framework that leads to resilience and that facilitates the investment in future resilience. What actions do we take? In a micro sense, we look at loss estimates by loss bearers, but that's only the first step in order to suggest risk mitigation measures as well as policy decisions, which are more and more looking beyond the strict financial environment that's traditional to financial regulation. With this, I'm handing over back to the moderator.
Thanks so much, Dan, for that. And lastly, but definitely not the least, we have Richard Freund, who covers sustainable infrastructure and municipal finance on CDP North America's capital markets team. In this role, he oversees engagement with a range of global investors, underwriters, credit rating agencies, and other capital market participants on municipal sustainable infrastructure development and municipal climate risk disclosures. Over to you, Richard.
Thank you. So CDP, and thank you for the introduction. I appreciate that very much. CDP is also an investor-focused climate change nonprofit based in London, and are big fans of the Climate Bonds Initiative. We essentially operate the world's largest voluntary environmental data reporting platform, which is quite a mouthful, but essentially the world's corporations and subnational governments report their climate impacts to their various audiences through a standardized and comparable format, which CDP operates on an annual basis. And fundamentally, the vision here is that in order to manage risk, as was key in the communications around this event, you have to know what the risks are. And so fundamental to doing that is a process of transparency and disclosure that facilitates insight, thereby enabling responsible risk management. CDP fundamentally is the gold standard for the world's understanding of what is happening and who is making what impacts where. In terms of who our stakeholders are, we represent, we make these requests on the corporate side on behalf of over 560 investors, institutional firms primarily, but also asset owners, underwriters, insurance firms, and pension funds, representing over $106 trillion in assets, as well as on behalf of over 150 corporations that utilize CDP disclosure annually to understand the impacts of their suppliers and work to decarbonize and manage risk in their supply chains. We collect disclosure annually from over 10,000 companies, over 800 city and county governments around the world, and over 125 states, provinces, and regions. And fundamentally, the main takeaway to have is that this data goes everywhere. As the world's largest source of this sorts of information, we work very hard to ensure that this information doesn't just flow to the capital markets through the investor population I mentioned earlier, but also into other third-party environmental, social, and governance data providers, as well as into various tools, academia, policy circles, other nonprofits, development finance, and then various capital markets products in general. And I'm sure we'll be speaking a bit about that later in the event. So just to focus on Canada for a moment, I was particularly delighted to share that in 2020, as CDP's disclosure operates on an annual cycle, we had 26 Canadian cities disclosing with CDP, as well as one Canadian city disclosing for the first time, which happens to be Surrey. So I was delighted to be joined by Matt on this panel and congratulate them on their climate transparency. We also had 5 provinces disclosed in 2020. So that's a sense of who we are. And given the themes, I wanted to focus on the municipal subnational governments whose climate risk disclosure comes through CDP. But we do also have hundreds and hundreds of Canadian corporations that disclose as well. And I look forward to the conversation. Thank you.
Thanks so much, Richard, and thanks everyone for sharing. Our panelists were so on time that we're actually running slightly ahead of schedule, which means that we have lots of time for audience Q&A. And so a reminder to all the attendees that you can submit questions for our panelists that we will get to after our interactive dialogue. And so to submit your questions, you can click on the Q&A in the Zoom control section, and you should be able to submit your questions there. So now moving into our interactive dialogue section, Matt, my first question is for you. Are you able to describe the effort and approach that went into the cost benefit analysis for the Disaster Mitigation and Adaptation Fund that you spoke about?
Great, thanks very much for the question. So yeah, just for a bit of context, the City of Surrey applied for the federal government's Disaster Mitigation and Adaptation Fund. And as part of that application process, providing a cost benefit analysis was highly encouraged and possibly mandatory. So we didn't want to omit that important step to increase our chance of securing the investment. So I must say, as an engineer, I'm very comfortable with estimating costs of construction and those types of things. But to calculate the benefits for our project was a bit daunting at first. So we weren't sure what the final result would be, and the guidelines were stating in our funding application that we needed to find at least a benefit of 2 times the cost of the project. And it had very little guidance on how to calculate this, but it did allow calculating the benefit over the entire life of the infrastructure that was being funded. And so that was a big clue for how to conduct this, because a lot of times a flood event, we think about it happening just once and trying to calculate the damages from just a single event. But for Surrey, what we'd found with 1 meter of sea level rise, a 200-year event, so an extreme flood event of today, would happen expected about once every 2 years in 80 years time. So a lot of the infrastructure that municipalities build, we want to have a very long life. So 50 to 100-year life cycle is very common. So that was a big driver in our calculation, was making sure that we could account for the fact that this infrastructure that we're building now will be subjected to extreme flooding 100 times more frequently by the end of its life. And so what we then did is started to figure out in an extreme flood what the damages would be. And we were quite surprised with how significant the damages were. And of course, with a frequency of every 2 years at the end of the life cycle, you could accrue a lot of damages. So for us, our floodplain, we have national, regional, and international railways that crisscross the floodplain, and particularly the national railway has a very high load. So we found a lot of benefit would be realized by the railway sector. Also, there are a lot of residents in the floodplain, so we found life safety to be a big driver in our calculation. And so in the end, we calculated a benefit to cost ratio of 126. And what we thought would just be kind of an exercise just to confirm we were eligible for the funding turned to actually be quite a big driver for building the support to move forwards with the project.
Great, thanks so much for sharing that. And that really speaks to the concern about initially about the business case that you folks. And so really helpful to hear from you about incorporating those cumulative co-benefits and costs in the analysis. Ujala, moving over to you. Thank you for providing that overview of and the positive news about the availability of capital there. Maybe speak a little bit about the investor appetite for resilience bonds. Is there an appetite there? And so would love to hear from you on that.
Yeah, thanks for that question. And I don't think there's a clear answer, but there are some signals. So I think that the investor demand for green bonds is very clearly there, as we've seen in the market. When a green bond has been issued, it's generally oversubscribed. They are kind of like hotcakes for issuers. And really the problem has been the opposite, that there is a lack of supply and which is far outstripped by the demand by investors. And I think one of the reasons for this, well, there's several reasons, but one reason is, as I mentioned before, green bonds are great because they don't necessarily require like a niche investor. They're not looking for niche investors. They're, again, just like vanilla bonds with an added benefit. Of course, there are some additional costs related to issuing a green bond, but those are generally not very large, they're marginal. And so investors love this because it's like a plus. It's a bond plus where they can also meet some of their sustainability targets. Now, in terms of the resilience aspect, again, because I think a lot of investors are looking at green bonds from the perspective of not just the green side, but the regular sort of return and the coupon rates and everything. If these bonds can also incorporate resilience and adaptation, I don't see why the same kind of demand wouldn't translate over. However, I think the issue is what people have mentioned in the Q&A, I'm sorry, in the question that you asked earlier regarding the investable pipelines, the business case. So how do we get investable pipelines that we can aggregate and put, and use and structure within bond frameworks? So again, I think to answer your question, the investor demand is quite high. It's really the supply where some of the issues are. And if I may touch just quickly on some ideas on how we can address the lack of supply. I mean, I think that this is a huge question, but one of the underlying problems here is definitional and guidance and capacity to create the kind of project pipelines that we're discussing. So definitional, I think, is a real key sort of barrier. If we don't know what resilience investments are, if issuers don't know what qualifies as a resilience investment, then it's very difficult to move forward. So there is a real need for that framework and a harmonized framework that is across the board understood by issuers and investors alike. Secondly, is the ability to actually issue bonds. Green bonds is a major barrier. So there's a lot of work to be done there globally, and particularly, I think, in Canada, on how do you actually issue the green bond? How do you create the framework? How do you, take the steps that are required? And then finally, I think the third one is really, how do we scale? So first is define, second is how do we start moving? And then third is, how do we get to the scale that we need? And I think for scale, we really need regulatory and policy action to sort of bolster this movement. So those are some early thoughts on how we can move this dial forward on the actual issuance of bonds.
Great. No, thank you so much. That leaves us a lot to chew on. And I see we're already getting questions from the audience based on where we were leading the discussion. So thanks for that. Dan, my next question is for you. I'm hoping you can describe the effort and the approach that BC regulator is taking to assess the natural perils to the BC financial system.
I will answer the question in a minute. Before that, I would link into something Ujala said, the challenge of scale. And when she talked about this, I couldn't help thinking about a regulatory requirement for financial institutions to hold a certain amount of their reserves, financial reserves, in liquid instruments. And the default for the liquid instruments is government bonds. But actually, there is no inherent reason to hold government bonds. It's just their liquidity, the fact that they can be bought and sold very easily. Now, if green bonds would satisfy close to this requirement, then you can imagine how institutions who want to engage in green investing would say, oh, I will invest my liquid assets in these green bonds instead of the government bonds. And if you imagine the resources of financial institutions and the reserves that they are holding, scale will not be a problem. Maybe we should talk. But back to the question, what does the regulator do, and how does natural peril come into financial regulation? If we think of our core mandate to protect consumers of financial services, the first step in this is to make sure that the institutions that engage in financial services are sound. And to that end, think of a lender. The credit risk of the lender is mitigated by and large with collateral, real estate. So by far the biggest part of financial services in Canada is lending to individuals and corporations against real estate assets. So that mitigates the credit risk of the lender. But that introduces a residual risk because real estate is solid and real until some disaster takes it away. So by engaging with the financial services sector and ensuring that financial institutions recognize this residual risk, we make climate-related risks and natural catastrophe risk an integral part of the risk assessment framework of financial institutions. And of course, financial institutions do this for their own benefit, but the regulator has an important role in encouraging the best practices. And the best practices include the natural catastrophe risks in the overall risk assessment. Again, speaking of climate-related or resilience-related investing, part of the sector we regulate is insurance, and insurance companies do invest in fixed income instruments. Again, the regulator engaging with the insurance companies could ensure that the climate risks are viewed not just part of the liabilities of insurance companies, but also of their assets. And an overall view of risk should be taken rather than just focusing on liabilities.
Thanks, Dan. And as you mentioned, the importance of risk assessment and the best practices associated with that. And that leads to the other key part of the equation, which is climate risk disclosures. So my next question is for you, Richard. We'd love to hear from you on, what is the market saying about climate risk disclosures? And how do investors think about municipal risk disclosures, and how do the banks differ or overlap based on this investor interest?
That's a big question, but at a top level, climate risk disclosure is critical, and I think traditionally the corporate sector was a bit more advanced in terms of there's of course still much more work to do, but generally there was more pressure applied via the sort of shareholder relationship to publicly traded corporations, and there's a bit more precedent historically for that. In the municipal side, that's a bit less common, although becoming that is becoming more standard gradually. And fundamentally, that sort of disclosure is critical because it's a proxy for governance. And so what investors, whatever asset class they invest in, will tell you is that if you see an institution that is not taking climate risk seriously, the immediate next question that investor will ask, and frankly that lender would also ask in the case of banks, is, well, what else are they not taking seriously? Because if you're not going to demonstrate to me that you're seriously considering these risks that we as a financial institution take seriously, then I'm concerned about what that means in terms of your governance and oversight as a borrower, period, full stop. And that's, I think that's where climate disclosure, and I was glad you mentioned the task force on climate related financial disclosure, is a critical part of the landscape because it is this standardized and comparable and relatively simple set of guidelines that can be well understood. And I can't help but mention that any CDP disclosure is also consistent with TCFD disclosure. So the city of Surrey, for instance, may not have realized this, but they were engaging in TCFD aligned disclosure by disclosing to CDP, and that's something investors deeply appreciate. In terms of banks, there's two things I'd note. The first is that, and again, these are gradual changes, but that banks are really beginning to do very interesting things, and they wield a place of power that's very different than the investor, investee relationship. There are banks in Canada that are now working on lending models that will enable them to tie the rate at which they're willing to lend to the climate disclosure and transparency of the borrower. Now, this hasn't happened yet, to my knowledge, in Canada, but I do know there are Canadian banks working on this. And I can say, as a concrete example, we've seen banks in other parts of the world take those steps. So the Japanese bank MUFG made a loan to the Japanese shipping company NYK last year, and they loaned the rate of the loan was tied to their CDP disclosure, actually. So they if they scored higher with CDP in terms of their climate transparency, they got a lower rate. And if their score drops in the future, their rate will go up. And so there is serious interest in the capital markets to reward positive sustainability disclosure utilizing those sorts of financial mechanisms. And I think the other thing, and this really ties in to what Ujala was saying, is that banks are very excited to have the opportunity to sell something that they feel positively about and they know the capital markets will respond to. And so recently, some of the most exciting developments I've seen in the municipal bond markets in the United States have come through underwriters insisting that that municipal issuers take the steps of utilizing climate disclosure explicitly in the official statements for the bonds they're putting out. And they do this because they understand that if they do something new and exciting, that's something that they can sell to investors, and that helps the underwriter, it helps the borrower. You typically get rewarded with a lower rate. That's marginal at the moment, but there are concrete examples of labeled issuance, so sustainable bond issuance or green bond issuance being rewarded by the market over identical bonds that aren't labeled. And the investors love it because they get to tell the people whose funds they're investing a great story about how they're doing good in the world. And so it is this mutually reinforcing cycle that we expect to see more of moving forward.
Great. Thanks so much, Richard. Yeah, that was really helpful in connecting the threads from the previous conversations there. The next question is for all the panelists, and it is a big one. So the question is, what do you think is the one big move that we can advance or accelerate today to foster investments needed in risk reduction and adaptation to work towards a resilient 2050 in BC's Lower Mainland? So I'll repeat it again because it's a mouthful. What do you think is the one big move that we can advance or accelerate today to foster the investments needed in risk reduction and adaptation to work towards a resilient 2050 in BC's Lower Mainland?
We could take this into account via the regulation of financial institutions. And once it's part of the investment horizon of financial institutions, then it becomes part of the normal financial flow. So it doesn't take, it comes out of its niche and becomes mainstream. I'm willing to be complimented or contradicted. So,
can you just restate it, Dan? I'm just trying to take some notes. What would you, in one sentence, describe as this big move?
What I described is a step apart of the big move, and that's making the niche that green investment is these days mainstream. And how to achieve that? Well, I know that financial regulation has a part in it, but there is more to it.
I think I'll just build on that comment, Dan. I think a big move to take this type of work mainstream to reduce risk reduction is for organizations to put it in their core mandate to manage risk. What we've seen in a lot of our discussions with other asset owners is they think that risk management is another organization's responsibility. And so kind of owning that risk and being part of the solution.
So are you speaking from the local government perspective, Matt, in terms of mainstreaming it within a local government?
Well, I think I can speak on the City of Surrey's situation where, yes, we're the local government, but the risk the community faces is really not just a municipal issue. It's a private issue with homeowners. It's a asset issue with highways and private railways, power lines. Like really any one of those systems failing due to a risk event affects our community. And so kind of broadening the discussion to be more mainstream amongst each sector, that risk management is really a core mandate item.
So I think, you know, this conversation is so interesting, and I'm just thinking about it in like two types of ways in terms of risk. So there's obviously the risk to assets and to infrastructure. And then there are risks, you know, not to individual assets, but to systems and interdependent systems, to cities, you know, and coastal regions, et cetera. And there, I think there are projects that are directly addressing risk. So like flood barriers, et cetera. So I think there's like two kinds of projects we're almost talking about. One is integrating risk resilience into existing assets and infrastructure, or planned assets and infrastructure. And then there's kind of system resilience building and assets that are, you know, really identified as that. So I think I'm going to speak on the second one, which is the systems resilience. And that's where I feel there's a huge opportunity, because in the bond market specifically, because there's, again, investor appetite. They're looking for projects to put money into. And these kind of projects are really attractive if they have, a demonstrable return on investment. And I think in the Q&A, somebody asked, Jennifer, I believe, asked that there's, is the ROI, the lack of ROI perceived or real? And I think it's absolutely perceived. And the reason it is because of the way that we calculate cost and benefits and the way that we calculate these. And I think Matt touched upon, the challenges in finding guidance and tools on how do we actually have a better way to calculate the benefits that are accrued from these kind of investments. And I think that's one of the big things is we really in BC, I think, need those tools and that guidance that people can use to really understand how to create the business case around investments in resilience. And I think that would open up, a lot of opportunity from the capital markets.
Everything that everyone is saying, I think, is universally true and highly applicable. What I would sort of tie the threads together here would be to say that the critical big move that I see happening now increasingly, but we need much more of, is really that the challenges of the people in various institutions who think about climate risk and think about sustainability and think about environmental management must become not simply the problems of those departments and individuals, but the challenges of everybody in any given institution, and understood as the ways in which that those contribute, to everyone's risk and everybody's long-term prosperity or lack thereof. And with municipalities, this is abundantly clear in terms of public infrastructure. If the people thinking about climate aren't yet talking to the Chamber of Commerce and talking about how what they know about risk is going to affect local business, that's really critical. And I'll just share a story. I'm not going to embarrass the particular city, but I was a few weeks ago speaking with the chief financial officer of one of the 5 largest cities in the United States. And, we were discussing climate disclosure, and she did not, she was new to learning about CDP, which is perfectly, that's all well and good. But I was introducing CDP, and she said, "Oh, it's so interesting that there are other cities that disclose, voluntarily to the capital markets like this." It just surprises me. I can't imagine that, it's something I'll have to think about doing. And I had the pleasure of informing the CFO that, in fact, our city had been disclosing voluntarily through CDP for the past decade. And she just didn't know this. And she didn't know that, investors and underwriters were going to CDP to read this because the quality of disclosure wasn't cropping up in the official statements of, that come out per actual bond issuance. And this is extremely common. This is not to single out this city. It's extremely unusual that, for instance, the chief sustainability officer and the chief financial officer in a city would know each other's names or have any idea what they're doing. And so by making those problems of the experts in climate risk disclosure, the problems of everybody that you possibly can, this ties in exactly with what Dan was saying. What you're doing is not making it a sustainability challenge or a climate challenge, but you're talking about risk. And I think this, the risk community understands this very well. But to the extent that we make the conversations that we have something that is not special, not optional, not, just an environmental thing or a sustainability thing, but something that is absolutely critical for everybody, the more that comes through in our work, I think the better off we will all be.
Thank you for all those responses. So we got role of financial regulation, integrating climate risk and overall risk management systems and processes, creating tools and resources for developing a business case for investment in resilience, and lastly, breaking down those silos, and because climate risk touches everything, and how can we enable that and push that forward accordingly from a resourcing perspective, and enhancing collaboration through that. So thanks everyone for your responses there. And looking at the Q&A submitted, to the questions submitted from the audience here. Again, I would encourage anyone, if you have any additional questions, please feel free to add them in the Q&A, but we'll get started with the first one here from Rebecca Lee is the one that I see. So the question here is, for the work in lower mainland, the extreme land values really skew the cost of projects or the benefits of the projects. Have any of the panelists had experience working around this issue? Dan, maybe I'll go to you for this question.
Yeah, I'm happy to start it off. We have done a little bit of work, and we started the project. It's in flight. The risk assessment is looking at the value of a property as a component of the sum of two components. The land, which is what Rebecca is indicating, as separate from the structure, because the impact of a natural disaster or even a long unfolding risk related to climate change impact the structure and the land differently. Below a certain threshold, it's only the structure that is affected. Structures can be replaced much more easily. The land value can only be impacted by truly catastrophic events that change the character of the society and the economy based on that land. So if we look at that as the tail of the tail of the events, and everything else is related to the structure, then things at the same time more manageable when we focus on just the structure, and perhaps a little bit more sobering, but it's the tail of the tail. So we can afford a little bit more time, let's say. The two streams can proceed at different speed, different intensity. Now, this is not a great achievement for us, but having taken the first step, we are still happy that we are moving in the right direction. I don't know if this is the thrust of Rebecca's question, but it's something that we have already started.
Thanks, Dan. Matt, just wondering if you have anything to add to that?
Certainly. Yeah, so for Surrey, definitely all the land values here are quite expensive, but we do see a relative difference between farmland valuation and single family home valuation. And so when we were developing a project for flood protection and adaptation, we had to be cognizant that we had to balance those needs, and just going with the project that had the very highest land value protection wouldn't be reflective of our community values. So even though today's talk is about financing and really the financial benefits, there is more to the equation than just the land valuation. And in our example, we looked at other community values such as the environment, recreation, agricultural, food security, and so on. Yeah, I think absolutely with such high land valuations here, you have to think a bit broader than just strictly the valuation of property.
I would just add from my experience, and Ujala was part of the adaptation conference where we had Graham Watt on from Grand Forks. And I think this question about land values comes up a lot in the conversations about managed retreat or whatever term you like to use there, because of, yeah, in the lower mainland, the land values being so high. And so Graham was really bringing to that panel at the adaptation conference, this lens of, it's not always about straight up buying out property. There's a lot of different ways to look at transfer of density and development rights as opposed to straight up buyout programs. So that's the one thought I had there. But Rebecca, are you able to speak and ensure we're capturing the essence of your question here?
I think so. Can you hear me?
Yeah.
Yes, we can.
Yeah, so I think I didn't really have a particular question, but just sort of wanted to have that in the dialogue because that's something that sort of throughout the URBC stuff, I haven't heard a lot of discussion on extreme land values, because that does really put in, it really does limit what's possible. Just sort of working on some farmland in the Fraser Valley. And so you get into these really skewed perspectives that even though it's farmland, it's worth an inordinate amount of money. And so what you're doing and what you're able to do is really limited by those high costs of the land. So thanks for your comments. I was excited to hear more about that. Those kind of thoughts from the panelists.
Sounds good. Thanks, Rebecca. Richard, maybe I'll pass it on to you to add a comment there as well.
Yeah, thank you. I wanted to make the point that, there's an equity angle to this that can be pernicious and that we have to be very cautious with. And I think I'd be curious to hear what Ujala thinks is on this topic as well. But we're in this, certainly CDP as an organization is in the position of celebrating leadership when we see positive climate risk disclosure. We're well aware that in general, wealthier communities, wealthier corporations, and larger corporations and communities are much more likely to have the funding available to hire the expertise necessary to engage in climate risk disclosure in the first place. And as we look to celebrate the leadership of those that are doing well, we also have to be very careful not to penalize or limit opportunities from institutions that can't afford to even have the expertise necessarily to do a climate vulnerability assessment, or even, some sort of, resiliency and basic resiliency and risks assessment. And that's really something that this community, I think, is we're able to walk and chew gum at the same time, but it is something that we're well aware of. Certainly when we look at who are our leaders, typically there's a concentration of expertise in places that can afford to have that on staff. And I think that's a place where, again, just cautious and thoughtful design, particularly around financial models, is critical to making sure that those benefits are not being distributed in an unequal manner.
Thanks for that. And a really good point about enhancing the capacity building there to ensure an equity lens is placed when addressing this question. The next question we have here is from Wilma, and this really gets to the question about the business case. So how do we bridge the dissonance between annual capital budgets and, for example, approved by Treasury boards and the total cost of ownership, which is over decades, not to mention the reducing cost, really getting to the short-term and long-term time horizons there when it comes to budgeting decisions. Matt, maybe passing it over to you to respond to this.
Sure. Yeah, that's a great question. And I think really what the question speaks to is that the cheapest option of today may not be the cheapest option in the long term, especially with climate change and increasing costs due to increased hazards such as flooding. So maybe just to give an example, we had one of the projects in the federally funded suite of projects was a bridge replacement owned by a private railway company. And the cheapest option for them would be to replace a like-for-like bridge made out of wood that would still be vulnerable to flooding in the future. And so it was quite a lengthy dialogue we had with that owner to figure out, is there a sort of an arrangement where we could share costs such that the overall cost to society would be lower. And so over a number of months, we had these discussions, and in the end, we reached an agreement where the bridge would be built more expensively today, but it would last for longer, and it would also prevent flooding. And so one of the key sort of barriers that overcome that was the federal funding we received had 25% funding for private assets, and then the city was able to pitch in matching funding. So that funding really made each party better off in the long term, and we were able to reduce the risk. So it's hard to make a generic statement about how you bridge that difference. It's quite specific to each project, but I think really having had many years of discussions with all the parties and understanding each organization's concerns and pressing needs allowed us to kind of have that position where we could come up with a better solution to move forwards with. And having a good handle on the risk really was key to making that.
Matt, can I just ask you to clarify the 25% allocation from DMAF? There was some stipulation around. Yeah, that's interesting.
Certainly, yeah. So in our under the Disaster Mitigation and Adaptation Fund, they offer a sliding scale of how much the federal government will contribute depending on the category of the asset. So if it's a privately owned project or asset, it's 25% federal funding. If it's municipally funded, it was 40%, provincial 50%, or First Nations owned 75%. And so different formulas applied. And so it was definitely very, like, I don't know exactly what the average cost would be, but 25% seemed to be kind of borderline whether that's enough to build something today so it's resilient into the future. Certainly at 40%, that was a very easy sell to make something resilient for the full life of the structure. And so for each type of project and conditions, it'll probably vary, but that was our experience. It was somewhere between those two ranges.
I think this links actually with Murray's question on time horizon as well. Because whenever we have the potential loss distributed over more than one loss bearer, and the example of the bridge is very, very good for that. You have one loss bearer with a shorter time horizon and another one with a longer time horizon, but there's only one bridge. How do we deal with this? And in Mari's question, this is very pertinent. What time horizon do we use to assess risk? For us in the risk community, the time horizon is crucial because losses may happen beyond the time horizon of a potential loss bearer, in which case there are no consequence to them. So recognizing this difference is what made us, the financial services regulator, attempt to bring everything together, at least from a financial services, financial loss point of view, and seek to cascade losses coming from a given event through a number of stakeholders. The answer is never simple. Even with the bridge with two stakeholders, imagine something more complex. It's not simple, but the very first step is to talk about it, to recognize it and talk about it. And it's only through a series of conversations and the coming together of major stakeholders that we can hope to achieve a more holistic approach to risk mitigation, and resilience. Again, I'm not telling news to anybody, I don't think, but it's important to move beyond the silos that have been prevalent so far, where each loss bearer views their problem individually, although it's not their problem, it's our problem. I look forward to see further versions of our loss model.
Yeah, thanks, Dan. And I'll maybe read out the question here, which you answered, and open it up to other panelists to chime in as well. So this is from Murray around the question of time horizons. For those of us who provide quantitative risk assessments for use in the public domain. Do you have any recommendations on time horizons and discount rates that should be used for assessing return on investments for proactive mitigation and adaptation measures? And is there a best practice emerging in the fields of climate change adaptation or disaster risk reduction?
Yeah, I'd be happy to take a first stab at that. Building on what Dan said, I think it depends, but in general, and this is really sort of looking at what people are doing in response to the past couple of years of sort of living in a post TCFD, a post Task Force on Climate Related Financial Disclosure landscape. If someone, I would generally be skeptical when someone says, "Oh yeah, for sure, the correct rate is 8%. That's your discount rate." It obviously varies project to project and place to place, person to person. But the thing that is helpful is less trying to settle on a correct number that'll adequately capture potential risk. In that, I don't think any of us truly can project that out. But what is helpful to know is for a given project, so to go back to Matt's bridge, understanding what at what point would you go negative. So if I'm planning a given project and picking a different rate, I want to understand at what point is this something that is positive in terms of revenue and income as opposed to negative. And once you understand that point and you can disclose around that and communicate around that at various time horizons, I think it's the process of having demonstrated that you understand where that failure point is for different rates and at different time horizons that's more important than actually trying to get the correct one, given how challenging that is. And so fundamental to what the TCFD encourages organizations to do is for companies to set a definition of short, medium, and long term for them. On the municipal side, there tends to be more standard practice in terms of what is short, medium, and long term. But for corporations, that's generally something that's left up to the individual organization. But, pick those three categories, define them for yourself, or use, an acceptable standard based on what your organization is. And just understand what that failure point is. And if you can demonstrate you're doing that, you will have accomplished the vast majority of what anyone that needs to understand your responses to that will want to have on hand.
I don't know if other panelists wanted to jump in, but I was also going to offer an opportunity for Wilma and Murray to speak again, just to make sure we're capturing their questions. I'll unmute Murray here.
Yeah, Richard, that was a very helpful response. I think that is a very constructive way to move this work forward, because ultimately we're trying to build a shared understanding of where those breakpoints are. So my question was really for purpose of comparing a business case for one hazard against another, kind of looking at that multi-hazard lens. How do we compare across those different domains? And but your point is extremely well taken, and I appreciate your insight there. Thank you.
Wilma, are you with us still? And did you want to chime in? Did we answer your question about bridging the dissonance?
Yeah, I would appreciate if anybody has more advice on specifically what's the shortest path to reach some consensus. I work in the building sector, so is there, I think if having a standard or some consensus of what may evolve into a standard would help. So instead of a case-by-case basis. So I'm just wondering, does anybody have any tips on where to start? Yeah.
Maybe I can quickly jump in, and I think it sort of relates to this question here from Jack as well, around the role of resilience rating systems in terms of helping private property owners access capital, perhaps something similar to the LEED standard, and it also asks, how do you think investors can evaluate ROI? So it relates back to the question around Wilma's question around the annual capital budgets and the time horizon dissonance that comes into play. Having worked in the commercial real estate sector, very familiar with this dissonance, and I think the role of education and collaboration between teams is really important. So, are the property managers talking to the asset managers? And at the end of the day, it's in situations where this has been successful, where we're able to make the case for those longer term investments, is really around ensuring that everyone, all the stakeholders, are on the same page when it comes to understanding the long-term risk. The hold of the asset as well is a key component. For how long in the portfolio are you expecting to hold a building for? And so is the investment able to kind of match that time horizon as well, is something that comes into play, because at the end of the day, it's the asset managers, and the investors really approving those budgets. So understanding of that risk and really integrating that risk within the climate risk within the overall risk management of the property valuation is something that's really important. And maybe I'll just quickly touch on the other question about developing some sort of a resilience rating systems. So we find that most commercial real estate investment organizations report to a framework or a benchmark called the Global Real Estate Sustainability Benchmark. And over the past 2 years, I believe 2 to 3 years, they've really started focusing on assessing resilience of a building portfolio. And this is information that the investors really use to assess the sustainability performance of their real estate portfolio. So this is something that we're seeing being integrated into into this real estate specific reporting benchmark that investors are using. And we're also seeing standards like BOMA BEST. So BOMA BEST Building Standard, I believe they have or have started to include building resilience or climate resilience as part of their green building standards as well. So I think this is slowly being integrated into these existing systems, but maybe I'll pause there and have the rest of the panelists maybe chime in.
I'll add something from my own personal experience, if you want. I lived in several parts of the world, and in one such part of the world, buildings have a rating. When they get transacted in the market, I'm talking about individual homes, they get a rating. So they are category 4, that means there's barely indoor facilities, while category 1 is one step below luxury, where everything is there and everything is brand new. So the parties to the transaction understand what they are trading, not dissimilar to credit rating for bonds. Not all bonds are the same, of course. So that's in one part of the world that I have seen. And the need for such standards has been presented very starkly by the strata insurance problem that has appeared in BC, first slowly and then swiftly last year, because lack of such a standard means that any maintenance investment is a shot in the dark. The investor doesn't know why they will do that, unless imminent destruction of the property is threatening the owner. It's hard to put a price on that maintenance investment, and therefore it's hard to make the decision. More often than not, those decisions get deferred and the problem exacerbates. And another comparison between different parts of the world is the assumed life of an asset. In London, England, the houses we had were built between 1870 something. Actually, no, the oldest was 17 something, and the most recent was 1923, let's say. And that's large parts of the housing stock. So the English expression safe as houses is actually born in reality. A century worth of life out of an asset is not unthinkable. In fact, is expected. But if we think of the guarantees for new homes that we see around here, that's only 25 years. So it's much, much shorter. That does not reflect it into transaction prices. We don't see this reflected in the transactions. So a rating system would be a huge bonus, not just to sustainability, but would make finances, personal finances and commercial finances much more solid.
Great, thanks so much, Dan. And with that, it's hard to believe, but we're already on at time. So thanks everyone for joining us, and to the panelists and to the audience for participating. Really enjoyed the insights and the perspectives that were shared on this very important topic. And so I'll pass it on to Jessica to wrap it up.
Thanks so much, Puninda, and thanks to everybody for sticking with us. Also a huge thank you to our note taker, who I believe was on with us, Jonathan Eaton. Our note takers, the whole URBC symposium is made possible by a small army of volunteers in the background who are doing graphic recording and taking notes for us, and making all of those pieces come together behind the scenes. So huge thank you. In lieu of speakers' gifts, we are making, the URBC Organizing Committee's made a donation to the organization Preparing Our Home, which supports Indigenous youth in becoming emergency preparedness leaders in their communities. So thank you on behalf of the Organizing Committee for your time. Thanks again to our panelists, a huge appreciation for your time and contribution to this discussion. And a huge thanks to Daryl from the Organizing Committee, who's running all the Zoom technology and making everything happen. And yeah, we'll see you hopefully on the online sessions coming up.